What's up? Yo, this is Korean Bro. Today is 2022, December 6th, and what I'm going to do is uh, what I'm going to do is look at economic calendar as always, and go to mollyfo.com. And marketbit.com. Okay, let's go to economic calendar first. As far as I remember, today we have interest rates news. Okay, December 5th, December 6th. December 5th, ISM non-manufacturing PMI, and on December 6th, EIA short-term energy outlook. December 7th, crude oil inventories. December 8th, initial jobless claims. On December 9th, PPI. And let's go to yahoofinance.com and see the overall mood. Investors can't miss the forest for the trees in conflicting data. Okay, does it say anything about interest rates? Why this Wall Street Bear says it's time to sell stocks again? Okay. It doesn't say anything about interest rates. I think it's because interest rates announced on December 5th was not as critical as I had thought it would be. So I guess that's the main reason. Hold on. Okay. It doesn't really say anything about interest rates. Let's type interest rates and see what happened. Okay, interest rates. And let's go back to economic calendar. December. It doesn't really say about interest rates. Maybe it was not really critical. Because from what I see, I don't see any articles related to interest rates so far. Okay, then let's get back to motleyfool.com and read some of the articles first, and then go back to Yahoo Finance and what else? Marketbeat.com. Okay. Um, the SaaS stocks are boosting on Nasdaq Tuesday. Two ultra high yield dividend stocks to buy, hand over fist, and one to avoid. Three things that should really bug Netflix investors. Two rare buying opportunities for growth stock investors in the Nasdaq bear market. Three supercharged growth stocks with 393% to 1,153% upside in 2023. The Nasdaq moved slightly higher in pre-market trading Tuesday morning after steep drop Monday. GitLab reported strong growth in its development, security, and operations software platform business. Similarly, sales grew at a solid pace as it seeks to become profitable. Okay. The Nasdaq moved slightly higher in pre-market trading Tuesday morning after a steep drop Monday. Okay. Investors are bargain hunting in stocks that have seen big declines in 2022. The bear market in stocks during 2022 has hit investors hard. The damage has been particularly evident among tech stocks and Nasdaq Composite. After several years of outperforming other major market indexes, the Nasdaq has had to deal with many of its stock listings seeing steep share price declines of 50% or more this year. On Tuesday morning, however, it looked as though the Nasdaq would get some relief from Monday's sizable drop, with futures contracts posting gains of about 0.25% in pre-market trading early Tuesday. Among the bright spots on the Nasdaq were substantial gains for software as a service stocks GitLab and Similarly, both of which announced quarterly financial results that gave investors confidence in their ability to bounce back in 2023. GitLab. I use GitLab, so I honestly believe in its potential because I do think that it is really useful. Let's look at price level first. Its current price is 38. And all-time high was 130, which was the price in 2021, October 14. And its revenues keep growing. Its quarterly results shows that its revenue is growing as well. Okay. GitLab sees continuing demand. Shares of GitLab jumped 18% in pre-market trading Tuesday morning. The provider of development, security, and operations software released third quarter results for the period ending October 31. They showed that its enterprise customers continued to pursue their digital transformation efforts, even in a slowing macroeconomic environment. Even if we have a slowing macroeconomic environment, a lot of enterprise customers look for digital transformation. GitLab's financial numbers were strong. Revenue jumped 69% year over year to $113 million, all of which came from organic growth. Dollar-based net retention rate remained above 130%, and the company reported significant improvement in its adjusted operating margins. GitLab still lost money, but adjusted net losses of $0.10 per share were significantly narrower than the $0.34 per share loss the company reported in the year ago quarter. Okay. GitLab also saw a big uptick in the number of large customers it serves. The number of clients paying $100,000 or more annually on its SaaS service rose by nearly half to 638 over the past 12 months. So number of clients paying for SaaS service increased. So that means the number of clients who paid for a service like GitLab also increased. Okay. Um, with key tools like its cloud seed migration tool, helping its customers adopt cloud computing more efficiently through GitLab's collaboration with Alphabet Business Unit Google Cloud. So GitLab's growth was possible because they collaborated some of their work with Alphabet. Increasingly, big companies are adopting DevOps platforms to improve IT performance and bolster security of their network assets. Investors like the GitLab's guidance as well, as the company projected fourth quarter sales of $190 million to $120 million, adjusted net losses of between 0.14 and 0.15 per share, even without current profits. GitLab is demonstrating that companies still need its software, even as they look to cut back on spending in other areas. Even as enterprise companies need to cut back on spending in other areas, they still have to spend some of the money into software. Oh. That's about what I. Let's read this in detail. Let's get back to this one and DevOps platform provider GitLab. DevOps platform provider. DevOps. So GitLab is the one that provide a DevOps platform, right? GitLab. Recessionary headwinds are forming, but these cloud stocks look set to outperform. It's hard to find growth stocks that can withstand the heat these days. The sector has taken a beating in 2022 as rising interest rates have compressed valuations and fears of recession are weighing on growth rates. However, some companies are still putting up strong growth numbers even in this difficult environment. And these two are primed to deliver impressive long-term returns. GitLab, which went public a little more than a year ago, so it's been only a year or more than a year, so it hasn't been that long. Offers companies a single platform for DevOps, the tools business need to build and deploy software quickly. Single platform for DevOps, the tools business need to build and deploy software quickly. Okay. GitLab provides platform for companies to build and deploy software quickly. Okay, that's what it is. It's a winning market share in the industry as its offering can replace multiple point solutions, allowing its customers to work with just one vendor rather than 3, 4, or even 10. The company is also growing quickly. Its revenue jumped by 74%. While GitLab is unprofitable, its margins are improving and its gross margins are among the best in the software industry. with an adjusted gross margin of 89% in its most recently reported quarter, which ended July 31st. Unlike most software companies which are seeing sales cycle lengthen, GitLab is actually experiencing the opposite effect. The current environment is not slowing down customer decisions, nor elongating our sales cycles. Buying cycles have actually sped up across the business, and we continue to see strong win rates. Robin attributes that to the fact that GitLab helps business save money and delivers a high return on investment. In fact, according to market research firm Forrester, GitLab can deliver a return on investment of 4 or 7% over time as customers scale up their use of its services. GitLab stock market seems expensive, trading at a forward price to sales ratio of 10 based on that next year's estimates, but it's growing fast and bucking the industry headwinds within a $40 billion addressable market. If the company continues to see sales cycles shorten, the stock could be primed to soar even if a recession hits. It's one that I could definitely consider buying because I also use GitLab often. And I've been thinking that since I'm using it, it's not only me, but probably a lot of developers would feel the same way. So, GitLab. The next one we have is Sumo Logic. Shares of Sumo Logic also moved higher early Tuesday. Picking up 9% in the pre-market session, the SaaS analytics platform provider's third quarter results for the period ending October 31st indicate its most ongoing progress toward becoming profitable and generating consistent positive cash flow. Sumo's growth rate wasn't as fast as GitLab's, but it was good enough to make investors happy. Revenue climbed to 27% year over year to $79 million, with annual recurring revenue weighing in at $299 million, up 22% from the year-ago period. Losses narrowed from year-ago levels, with Sumo posting an adjusted loss of just $0.4 per share, thanks largely to its operating efficiency improvement efforts. Let's get to the next one. 3 things that should really bug Netflix investors. Netflix share of consumers' viewing time is contracting as people look elsewhere for entertainment. At least within the United States, Netflix also no longer the most used streaming service. Instead, with the rise of alternatives, satisfaction with Netflix services is slowly deteriorating. So people are less satisfied with service Netflix provides, and also viewing time is contracting. And in the United States alone, Netflix is not the one that people look for. People look for something else. Look for something much better entertainment. That's really bugging Netflix investors. Okay. Shares of U-Time, no longer the domestic king. Slumping satisfaction. Okay, let's get to really bottom. None of this is to suggest Netflix is doomed. It isn't. According to Hub Entertainment Research, the company is still the default video platform for 23% of U.S. consumers. So still 23% of U.S. consumers look for this company, Netflix. That's far and away better than the 6% sported by the next nearest streaming rival, Hulu. So 23% seems really small percentage, but then the second one that comes is Hulu, which account for only 6%. And even comparable to cable status of being the go-to option for 28% of United States TV watchers. Talk about a powerful reach. Okay. Nevertheless, it would be naive to believe Netflix carries the cash. Netflix carries the cash way consumers are used to. This will limit its growth going forward, even with the advantage of its lower cost as supported offering. It matters to investors because the stock 70% dropping since last November's high, a loss, most of which is still intact, makes for an enticing entry point now. Unfortunately, although Netflix shares are likely to recover the remainder of this setback sooner or later, such a rebound isn't apt to happen anywhere as quickly as many investors may be hoping. So tread lightly and remember there may be better risk versus reward prospects out there. So the point here is that Netflix the things that are bugging Netflix investors or viewing time, the fact that viewing time is contracting, and also it's not the main service that customers look for in the United States. And the third one is, I forgot what was the third one. Mm. Anyway, mm, uh, it's not the main service that people look for. They look for something else. They look for some um, another entertainment. Okay, next one we have PayPal and Datadog. PayPal is the most accepted digital wallet in North America and Europe. Datadog has a strong market presence in several verticals of the observability software market. In this bear market, PayPal and Datadog saw shares price fall more sharply than at any other point in the past. These growth stocks are down more than 60% from their highs, and both are now trading at attractive valuations. PayPal Holdings. Hmm. Economic uncertainty hit the stock market like a wrecking ball this year. The Nasdaq Composite is currently 29% of its high, putting the tech-heavy index deep in the bear market territory. During that downturn, PayPal Holdings and Datadog have seen their share price plunge 76% and 62% respectively, from all-time highs, making their sharpest declines at any point in history. That creates a rare buying opportunity for growth stock investors. The PayPal brand is synonymous with digital payments. Unlike traditional payment processors, PayPal operates a two-sided network that provides financial services to both business and consumers. The advantage helped the company build trust on both sides of transactions, supercharging the network effect that powers its business. In fact, according to CEO Dan Schumann, consumers are two times more likely to stop shop when a PayPal button is present on the e-commerce sites. Two times more likely to shop when a PayPal button is present on e-commerce sites. That's because of trust issue. People uh, have trust when they see PayPal button, right? Similar research from Nacelle suggests that PayPal drives higher order values and more repeat purchase for merchants. But so it's not only that, but also it drives uh, it drives higher order, mm, more repeat purchases. Uh, Those qualities led to strong adoption. In fact, PayPal is the most accepted digital wallet in North America and Europe. It ranked as the most downloaded mobile finance app worldwide during the first half of 2022, according to Apptopia. So let's go to Yahoo Finance and look at price level PayPal. Okay. Immediately, the company struggled with various headwinds throughout the year, including the loss of eBay as a customer, the inflation fueled deceleration in consumer spending, and the impact of unfavorable foreign exchange rates. So, we had a lot of headwinds this year, like mm, currency rate, interest rates, and what else we have? The loss of eBay as a customer. Hmm. Yeah, inflation fueled deceleration in consumer spending. Okay. Yeah, PayPal turned in a solid third quarter report. Revenue climbed 11% to $6.8 billion, and free cash flow soared 37% to $1.8 billion. Hmm. It's weird because mm, it went all the way till it reaches 279 uh in the year 2021, August 16. And in the year 2018, uh, the price was a 77. Compared to the price today and the revenue, mm, it's unsymmetric because supposedly its price level uh, should be somewhere 192 or somewhere, considering its revenue. Anyway, looking ahead, investors have good reason to believe PayPal could further accelerate growth. The company recently deepened its ties with Apple by adding support for iPhone tap to pay technology to the PayPal and Venmo iOS apps. Consumers will also be able to add their PayPal and Venmo branded payment cards to their Apple wallets next year. More broadly, Juniper Research says the number of digital wallet users will grow 53% to 5.2 billion worldwide by 2026. That trend should be a major tailwind for PayPal, given its strong market presence and with shares trading at 3.2 times sales, near the cheapest valuation since PayPal was spun off from eBay in 2015. Investors should jump on this rare buying opportunity. Datadog, okay, Datadog. Mm, Modern enterprise depend on numerous digital technology, from software and servers to cloud services. Datadog keeps those systems running smoothly. Its platform gathers and processes signals in real time from across enterprise IT environments, helping customers improve the performance and security of their applications, networks, and infrastructure. Like most great tech companies, Datadog has showcased a remarkable capacity for innovation over the years. In 2018, it became the first to combine the three pillars of observability, metrics, traces, and logs on a single platform, giving a customer unparalleled visibility across their software power systems. Since then, Datadog has continued to expand its platform, adding tools for user experience monitoring, cloud security, and instant management, as well as a powerful artificial intelligence engine that surfaces proactive alerts and automates root cause analysis. Hmm. The breadth of the Datadog platform is a key advantage. The breadth of the Datadog platform is a key advantage. It comes with over 600 pre-built integrations that simplify adoption for customers. Hmm. Those attributes have helped the company carve out a strong presence in observability software. In fact, IT research specialists got to name the Datadog leader in application performance monitoring in June. So they're like, what is it? Application performance monitoring leader. Application performance monitoring leader. Application performance monitoring leader. Okay. Software research marketplace G2 recognized Datadog as leader in database monitoring. They are like leader in database monitoring. Okay. And cloud infrastructure monitoring. Cloud infrastructure monitoring, database monitoring leader. Okay. In its fall 2023 report. In the third quarter, Datadog increased its customer count 27% to 2,200. And the company has maintained a net retention rate above 130%. As a key enabler of digital transformation, Datadog software should only become more important over time as enterprises continue to adopt more software and cloud services. In fact, management put its market opportunity at $62 billion by 2026, up from $41 billion in 2022. And with shares trading at a reasonable 15.7 times sales, a bargain compared to a 3-year average of 38.8 times sales, now is a good time to buy this stock. Okay. Next, three supercharged growth stocks with a okay. Not all EV stocks will be a home run for investors. Here's why Tesla still looks like a good buy and why you should avoid Canoe. Okay. Tesla stock hasn't exactly performed fantastically over the past year. The company's share price drop of 52% over the past 12 months has been fueled by supply chain disruptions. So the main reason stock of Tesla wasn't doing well is because of supply chain issues caused by China. Mm, okay, I get it. Okay. A chip shortage, CEO Elon Musk's distraction with his newly acquired Twitter, and declines in the broader market. But while this is the short-term narrative of the company, the bigger story looks much better. Consider that Tesla's vehicle deliveries increased 42%. The most recent quarter to 343,830 vehicles, and the company is on pace to reach a 2 million vehicle productions run rate in 2023. Tesla is years ahead of other EV startups and has continued to pull further ahead as it has brought new EV production facilities online. Investors should know that Tesla's share price isn't exactly inexpensive, with shares trading about 56 times the company's earnings, but it's cheaper than the astronomical P/E ratio of 344 times last year. Okay. One growth stock down 60% from its 52-week high. I'm buying hand over fist. With lots of growth still ahead, this fool plans to buy even more shares as his stock keeps falling. Zscaler. The more Zscaler falls, the more shares I've been buying. I've already added to my position 3 times this year. With the stock recently dropping another 10% after reporting its fiscal first quarter results, pushing it 60% below its 52-week high. I'm planning to add to my position again. Another strong showing. Its revenue is growing, and on the year 2019, let's look at year 2019. Okay. Stock shed another 10% even though it posted excellent fiscal first quarter numbers. Revenue surged 54%, while adjusted net income more than doubled from 0.14 to $0.29 per share. Both metrics surpassed analyst expectations. Meanwhile, the company continues to generate free cash flow. It converted 27% of its revenue in the period into free cash. They enabled Zscaler to grow its cash by more than $90 million to $1.8 billion. Strong demand for its cloud-based security platform. Okay. The company continues to benefit from strong demand for its cloud-based security platform. With cyber threats growing, more companies are switching from traditional network security setups to Zscaler's zero trust architecture. Traditional network security setups to Zscaler's zero trust architecture. So Zscaler provides network security programs. So instead of using traditional network setups, they use a service provided by Zscaler. Zero. Their service is called Zscaler Zero Trust Architecture. Okay, lots of growth still ahead. Despite all those positives, the growing macroeconomic uncertainty continues to weigh on Zscaler shares. So, what they are struggling is a macroeconomic condition because of its impact. They are struggling with stock price, right? They are struggling to gain investment. Anyway, that's due to concerns its growth could slow. The company is starting to see some headwinds as customers take longer to make purchase decisions. However, it has strong customer retention rate in the mid 19% range. Further, it continues to successfully upsell to existing customers, evidenced by a high dollar-based net retention rate that has been above 125% for 8 straight quarters. Meanwhile, even though it's taking longer to close deals, the company is seeing increasingly larger sales as customers consolidate security products by joining Zscaler's integrated security platform. So, the company is seeing increasingly larger sales because it's not only one product that they sell. In order for clients to use this product efficiently, they have to buy some other products altogether. Okay, that's here it says Zscaler's integrated security platform. Okay. The company believes it's in the early stages of capturing a massive total addressable market for cloud security. Okay. Let's see what CEO says. Hybrid work and public cloud adoption. Hmm. Public cloud adoption are now mainstream as organizations, large and small, are racing to ensure their business operations are agile, resilient, and secure. These generational tailwinds are durable, and my conviction in our $72 billion serviceable market opportunity is greater than it has ever been. He noted that in his talks with IT executives, cybersecurity remains their number one priority. No doubt, because the more and more, uh, regardless of the size of a business, the company will have their service. Uh, they will all in. Uh, they will all transform into something digital, right? So. mm. Uh, According to comments by Chandri on the call, the company remains confident it can continue growing and eventually reach its next milestone of $5 billion in annual recurring revenue. Earlier this year, it achieved its target of $1 billion in ARR. Okay, let's keep on reading because I feel this is really, really, really important. Okay, Zscaler continues investing in innovation to enhance its product portfolio and drive growth. Hmm. Chaudhry highlighted the continued innovation of its data protection offering on the call, which is gaining traction as customers are concerned about data leakage with employees working from anywhere. So the service that are they have planned to provide is protection of data. What customers are worried about is leakage of data, and the service they provide can protect leakage of data. Okay. The company's founder also noted that beyond our core products, we're excited about the rapid adoption of our two emerging product pillars: ZDX to manage digital user experience, and Zscaler for workloads, secure servers and workloads. Okay. Those emerging products give the company even more upselling potential, adding to the 6 times upsell opportunity with our existing customers just for our core ZIA and ZPA product pillars. Still only in the early innings of a significant opportunity for cloud security. Yeah, cloud will only get bigger as the years goes by. And along with that trend, security of cloud will be uh, important. It is important currently, and it's gonna be more important in the future. So the market, however, seems more focused on the current macro uncertainty than this long-term growth potential. That's why I plan to continue capitalizing on the style levels in Zscaler and buy more shares as the stock keeps falling. Yeah. Next, the next one we have is Shopify e-commerce tools. Shopify. Fast growing in end markets should help this company sustain their impressive momentum. Several technology companies opted for stock split in 2022. Okay, let's go to Shopify. Okay. Shopify executed its 10 for 1 stock split on June 28. Shares of the e-commerce platform provider have been on a roller coaster ride ever since, but the good part is that they are up roughly 23% since the split was executed. To be fair, Shopify stock is in a red hat on the market lately, gaining over 60% since the beginning of October and crushing the Nasdaq Composite's return of 8%. Investors can expect Shopify to remain a top performer in the long run as well because it is serving the fast growing e commerce market in various ways. From helping merchants start their online business with its website tools to assisting them in selling their products across multiple e commerce platforms, as well as providing infrastructure for payments and shipping, Shopify is in a nice position to take advantage of the e commerce market's growth. Not surprisingly, the company's offerings are seeing healthy demand from merchants, which was evident from the 22% year-over-year increase in its revenue to $1.4 billion in the third quarter. Its merchant solutions revenue was up 26% year-over-year during quarter three to nearly $990 million, driven by the growth adoption of its services such as Shopify Payments, Shopify Capital, and Shopify Markets, which the company says is a cross-border e-commerce management to the auto sellers to sell their product internationally. Now, the cross-border e-commerce market is expected to clock an annual growth rate of 26% through 2030. Similarly, the e-commerce payment space is expected to post annual growth of 11.5% through 2028. Therefore, the demand for Shopify solutions should head higher in the long run thanks to the expansion of the e-commerce market. Additionally, the company's steps to bolster its fulfillment network business should be another tailwind. Okay, today we looked at some of the companies. Tomorrow we'll look at some of the other companies as well. Okay, this is it. This is it for today, and I'll see you tomorrow. Okay.